David Spika is here. He's chief market strategist at Turtle Creek Wealth Advisors. David, welcome. And there's the argument about whether the policies are bullish and then the argument about whether they're priced in. So tackle both aspects of that.
Well, Kelly, I think we did see some pricing in when the market jumped 5% right after the election. But let's go back to 2016 when Trump had similar policies that he was planning to implement and the market continued to move higher. So we like cyclicals. We like U.S.-based companies. And we think, obviously, not all the policies that President-elect is proposing will get implemented. But if we get lower taxes and we get a better regulatory environment, that's going to be favorable for U.S. companies. And it will drive earnings growth higher. And we think the uncertainty that's moved away as the election has been completed will increase capital spending, also good for earnings growth.
There's no corporate tax reform this time around, and S&P multiples are at 22 versus 16. Does that cap the potential upside?
Well, I think valuation is something we need to keep an eye on. And so one of the things we're really focused on, Kelly, is we don't want to see an aggressive Fed rate cutting cycle next year. We want to see earnings growth expand, and that's going to require economic growth, capital spending, and animal spirits. And so the key today is that the market is looking for 15% corporate earnings growth in 2025. You're not going to get that if the Fed is cutting 100 or 150 basis points. The two just don't go together. So we would like to see continued strong economic growth, higher earnings growth than what we saw this year. And then ultimately, over time, the Fed can reduce the Fed funds rate to the neutral rate, which is probably 3 or 3.5%. But we don't want to see that quickly next year. We think earnings need to go up for the market to be able to justify current multiples.
No, I think that would make everyone feel better. And that's, again, the corporate tax issue, without that catalyst. But again, there's some positive signs, kind of broadly speaking. You're favoring cyclicals and companies with high U.S. revenue exposure. I think the revenue exposure overall is, 40% for the S&P 500? Maybe that's too high. But Martin Marietta, Visa, Intuit, 40% overseas, I mean. So that's the way that you're thinking about this.
Well, the market is expecting significant tariffs, which will have an impact on companies that generate a lot of revenues overseas. So whether or not the tariffs occur like they're expected to, obviously, those things are being priced in. So a company like Martin Marietta, which has virtually all of its revenues in the U.S., we think will benefit. It'll benefit from increased development and construction as they produce aggregate and concrete. And it's got a 15 to 20% earnings growth profile. Intuit's another company, virtually 100% of their revenues here in the U.S., they provide AI-driven tools for small and mid-market businesses and consumers, things like TurboTax and Credit Karma. And we think that the Trump policies and these animal spirits are going to increase activity in the small and mid-market business arena. And we also think consumer spending will remain robust. And that's one of the reasons we like Visa today.
Hey, David, it's Dom. How much are those animal spirits and how much of those Trump policies, how many of those Trump policies are predicated or need fuel from the Fed cutting interest rates? Is that going to be an important part of the discussion going forward? Does this market, in order to be constructive, need the Fed to keep cutting rates?
Not when and that's a great question, Don, but not when you're talking about tax cuts and deregulation. Now, clearly, President Trump will want to see lower interest rates. However, we believe that the best scenario for the market is to have normalized interest rates, and we'll get there over time, not right away, but most importantly, broad economic growth that will drive earnings growth. And obviously, we need that both in the U.S. and overseas. But at the end of the day, the optimism that clearly is coming out of this election is something that needs to continue. When you look at what gold's doing, falling, the dollar's rallying, these are all signs that people believe that at the very least, some degree of policies will get implemented that will be positive for the U.S. economy and for earnings growth. And quite honestly, we'd much rather see that than an economy that's slowing enough that the Fed has the impetus to cut rates rapidly. That's not what we want to see. We want to get back to fundamentals driving the market.